Okay, so here are some applications of accounting concepts. These are the most common ones that we'll come across. So first one, at the end of the year, we have paid £100 rent in advance. So that means we made a prepayment of £100 rent for an expense, and that shouldn't be included on this year's income statement. It should be next year's. So the concept of that is called accruals. And to fix it on the treatment on the financial statements and the income statement, we should subtract it from the rent paid account. And on the statement of financial position, we should have it as an other receivables, because at the end of this year, if I wanted that £100 back, then I would receive it back. So it's something I would be owed. Next one, at the end of the year, we still owe £100 rent. So it's similar to the last one, but this time we owe £100. So again, the concept is accruals, because it is an accrual, and also prudence, because if I don't put the full amount of rent on, my profit will be overstated. It will be higher than what it should actually be. So to fix it, on the income statement, we're going to add the £100 to our rent paid, because we should have paid it this year. And we're going to put it as an other payable on our statement of financial position, because at the end of that year, we owe that £100 rent. Okay, next one. We have received £100 rent in advance. So this time it's income, not an expense. And we received £100 rent in advance. So therefore it's an accrual concept again, because we've got a prepayment of income, which shouldn't have been paid this year, that should have been paid next year. And also prudence, because we can't overstate our profit. If I include that £100 on our income statement, it would overstate the profit. So to fix it, I'm going to deduct the £100 from the rent received account. And this one's the confusing one. So at the end of the year, the £100 that I've received extra, if the person I received it from asked for it back, I would owe them £100. So it's a liability. So we call it other payables. And the final one to do with all this was at the end of the year, we are still owed £100 rent. So it's an accrual of income this time. So our concept is accruals. So that £100 we should have received this year. So to fix that, we're going to add it on to the rent received account. And it's going to be an other receivable, because we should receive that £100. One trade receivable who owes 32,500 probably won't pay us. So that means that debt should be written off. So again, it's prudence, but it's also realization, because if we don't write it off, that 32,500 will always be on my trade receivables. So my assets will be overstated, because I'm never going to get that 32,500. So I need to write it off. So on the income statement, I need to put it as an expense, irrecoverable debts written off. And on myself, I need to subtract the 32,500 from the trade receivables. Now notice the difference. That was irrecoverable debts. This next one's doubtful debts. So we have been advised to make a provision for doubtful debts of 5% of trade receivables. Our credit customers owed us £34,000 at the end of the accounting period. So again, this is going to be accruals and prudence, because again, we know that some people won't pay their debts. So therefore I'm overstating my assets by putting the full 34,000 on myself. And also some of those people will not pay during that year. So that's why it's an accruals. The money that we write off should be included in that year. So on the income statement, we're going to put on the increase in the provision for doubtful debt, which is just 5% of 34,000. It's 1,700, and that's going to be an expense. And on the soft, we're going to subtract that 1,700 from the trade receivables. However, we still show the original trade receivables figure, and underneath we deduct the 1,700 and show our new figure, which we call the net trade receivables, if you want to call it a name. Inventory that cost the business £800 has been damaged. After repairs costing £100, it can be sold for £850. So the first thing to work out is the net realizable value. So do 850, take away 150, so 750. So the inventory, which cost £800, is really worth £750 now. So we value it as 750. And again, that's because of prudence. We can't overstate our assets. So in the income statement, I'm going to have to get rid of the 800 and put in the 750 instead, which is the same as just taking away 50 from our inventory. And do the same on the soft. So take away 50 from the inventory. Okay, the next one. The business has paid his, the owner has paid his mobile phone bill of £125 using the business check. Now, that money isn't got anything to do with the business, that's the owners, so it should be kept separate. And the concept for that one is business entity. And to fix it, what we're going to do is we're going to subtract the 125 from the phone bill account, whatever it's called. It could just be called telephone expenses, something like that. And we're going to add it on to the drawings instead, as we should have done. Okay, next one. Depreciation has been charged on our premises at 4% per annum, but property prices are rising, so let's forget about depreciation this year. So again, this is consistency. So even though the property prices are rising, we still need to keep being consistent with depreciation. What we could do is we could revalue the property at some point, and that would change the cost value. But until then, we need to carry on with the depreciation. So on the income statement, we'd have this year's depreciation, and the soft would add that on to the provision for depreciation, which would reduce the net book value. Next one. We send goods to H Limited on sale or return just before the year end. Let's put them into the sale to make this figure look better. So remember, sale or return means that I will sell goods to a middleman, a middle business, who will then sell those goods on for me, like a newspaper agency. So when I sell the goods to the middleman, I don't actually class that as a sale until they sell it on for me. Yeah, they're just like an invisible middleman. So if they haven't been sold yet, then I haven't made a sale yet. So that concept is realization, because I haven't made the sale yet. And on the income statement, I'm not going to put it in my sales because I haven't technically sold yet. H Limited hasn't sold it on for me yet. So I need to take it away from the sales and also include it in my closed inventory because I still have that stock until they sell it for me. I don't physically have it in my business, but it is still owed to me. And on the soft, again, I'm going to make sure I include that in my inventory. And if I've put it in my sales ledger, so if I put down that H Limited owes me that money, I'm going to deduct it because they haven't sold it on for me yet. I have just spoken to one of our best customers who's promised to buy £30,000 of any product. They are always reliable, so let's increase sales now. Again, no, we can't do anything worth the 30,000 until we actually get the money because realization. So on our income statement and soft, we do nothing. We do nothing until we get that money, or we have that money on credit, something like that, until the deal's been made. We spent £10,000 on office equipment this year. We also bought a calculator for £10. Now, I hope we will agree, £10 compared to 10,000 is very, very small. So I'm not going to include that £10,000 with the £10,000, although a calculator is non-current asset. Since it's such a low value, we class it as an expense and we don't bother depreciating it because of the concept called materiality. So on our income statement, normally we don't put non-current assets on, but since we're classed as an expense, we put it on our sundry expense. We put the £10 in the sundry expense, and on the income statement, we would also depreciate the £10,000 office equipment, but we wouldn't bother depreciating the calculator because that would be silly. That would be like 50p. And on our soft, we don't add the £10 to non-current assets. We do add the £10,000 office equipment to the non-current assets. And the last one, this one's tricky to get your head around to begin with. So we have non-current assets, which have a net book value of £15,000. However, they have a resale value of only £1,000. So I can only resell them on for £1,000. Now, what do we put in our financial statements? Do I put the 15,000? Do I put 1,000? Well, the concept called going concern means we're going to continue trading for the next few years, for the foreseeable future. Therefore, I don't have to worry about that £1,000 because I'm not going to resell my non-current asset anytime soon. So I'm going to keep it as the 15,000. So on the income statement, all I have to worry about is the normal depreciation. And on the soft, I keep the non-current, the net book value as 15,000 and depreciate as normal. I hope all that makes sense.